Save for a rainy day. We've all heard this kernel of financial wisdom, yet few of us actually practice what's preached. Nearly half of US households can't afford a single emergency expense. Corporate debt tops 90% of global GDP, and government shortfalls worldwide are worth $58 trillion. At every level, we teeter on the financial edge, hoping we never lose our balance and are woefully unprepared when we do. So, how did we get here, and will we learn our lesson from this latest crisis? Let's discuss a way forward. This is Globally Speaking. Thank you for joining us. We're exploring a very important topic, one that will affect the way we live and work for decades to come. Will the way we run the world economy meaningfully change in response to the societal strains of COVID-19? Now, we've assembled a diverse team of experts from around the world to help us figure out what comes next and answer your questions. You can also follow along with the conversation on social media using the hashtag #GloballySpeaking. And a little later on, we'll be speaking with Jean-Claude Trichet, former president of the European Central Bank. Now, he helped guide Europe through the immediate aftermath of the 2008 financial crisis. He'll share his perspective on how the world can navigate through this fresh downturn. So let's dive right into our conversation. Joining us from Berkeley, California is Maurice Obstfeld. He's the former chief economist at the International Monetary Fund. In Johannesburg, South Africa, Dolly Mokgatle is the co-founder of Peotona Capital. And in New York, Duignan is the co-founder of Rain VC. So Maurice, I'd like to start with you, and this question a lot of people were asking: why does the global economy, from individuals to small businesses to multi-billion-dollar corporations, consistently operate on the financial edge?
Since the last crisis 12 years ago, central banks have been supporting their economies with very low, in some cases negative, interest rates. And this has been a trend throughout the world. It has led corporations to borrow a lot. It has led governments to borrow a lot. So the whole world entered this crisis highly indebted. Now, that being said, unlike the last crisis, this one is not due to financial excesses or financial vulnerabilities. It is due to an objective disaster, a global disaster, the pandemic, which led economies through much of the world to voluntarily shut down to stop the spread of the disease. And this has had great economic repercussions.
And Dolly, why do businesses operate with such thin margin for error and little saved for a rainy day?
Executives, by their nature, do become exuberant at times in terms of profitability around their companies. They sometimes fail to take a very good environmental scanning of the market, as well as the pricing models of their products or services. They sometimes also do have a low risk assessment culture that can signal very big storms coming into the future. And as well, you'll find that sometimes executives take a very short-term view of profitability and sustainability, which may be impacted by the types of incentive schemes that are sometimes approved by boards. I think you find that businesses are not able to assess adequately their risk appetite, and their tolerance for risk is sometimes a mismatch between the real economy and what they believe are the elements or signals for growth.
And Erica, how do financial crises affect the financing and support for women and startups?
Where you're going to see the biggest pinch is for companies on the earlier side of that are looking for brand new relationships with new venture capital funds to make a first-time investment. And the reason that they're feeling the pinch is because all of the portfolio companies that are a little bit further developed and further downstream are coming back to their existing investors for bridge rounds to help them deal with delayed Series A or Series B. Since investors are getting usually very attractively priced rounds in technology companies that are actually probably growing even faster than expected due to the crisis and the fast adoption of technology, they're much more likely to double down supporting those existing companies through the crisis than to take a bet on a brand new portfolio company.
Maurice, is there something inherent in the capitalist system that encourages excessive risks that needs to be curbed?
Well, there are a number of distortions in the system that could lead investors to take excessive risks. We therefore have a structure of financial regulation, financial governance that ideally would curb the worst risks while allowing productive investments to take place. This is much more challenging in a global economy where you have national markets with different governance structures interacting, which is why we have organizations like the Financial Stability Board, the Basel Committee on Bank Supervision, to try to harmonize approaches to risk management across financial sectors.
Let's go to a question here from Chris Reyes in San Francisco. What kind of education system will best prepare the workforce for the post-crisis economy? Erica, let's go to you.
I think that, one of the critical things that we're really going to need our kids to focus on is getting actual practical experience in, real skills that can be applied in the workforce. So, for example, my son just got a job producing merchandise for, a yogurt shop in the neighborhood. And he was able to take, actual design and marketing skills that he got at school and apply it to a small business, an entrepreneur who could really use those very valuable skills. I think that practical knowledge of being able to get in there on the streets, build a social marketing campaign, actually work with a business and come up with creative ideas is going to be crucial for the future.
Well, we're discussing how the world economy can best move forward after the strains of the coronavirus pandemic. We'll be hearing from former European Central Bank President Jean-Claude Trichet a little later on. We'll get his take on what leaders can do to help the recovery along. This is Globally Speaking. We continue our conversation with our panel of experts. In Berkeley, California, Maurice Obstfeld is the former chief economist at the International Monetary Fund. In Johannesburg, South Africa, Dolly Mokgatle is the co-founder of Peotona Capital. And in New York, Duignan is the co-founder of Rain VC. And Jeanette Gentle in Noosa, Australia asks, will COVID-19 and the ensuing recession spell the end of globalization given the flaws in supply chains exposed by the virus? What's your take on this, Maurice?
There will be a desire to repatriate supply chains for security reasons. There will also be ongoing frictions, which to some degree have been intensified by the recent experience. A remarkable number of countries put in place export restrictions on medical equipment, medical supplies in the early months of the crisis. Many of those have been reversed, but it leaves a very bad sense of bitterness among countries, a very weak foundation for going forward with a multilateral approach to trade. Cooperation in public health has been basically nil. And there may be huge fights over vaccine distribution once vaccines come online. So there is a project of rebuilding the international economy that I think government need to undertake if we're not to see further fragmentation of global markets.
What can governments and corporations do to make global trade fairer for companies in emerging markets, Dolly?
For these economies to grow, they've got to be able to have equal access to markets where their goods and services can be sourced at fair prices. So if you look at our continent, and to take an example of the Southern Africa bloc, if I can call it that way, or the region itself, it will be very, very important that we harmonize things like regulation to ensure that access to markets are actually on an equitable basis, and we all agree as regions or blocks what would be to the best advantage of these emerging markets. At the same time, we can also make examples around those countries that produce certain commodities but are unable to sell them directly to the consumers of those commodities. So it's quite important that we open up those trade relations in such a way that small or emerging markets, farmers, etc., or traders, for that matter, are able to trade on an equal footing without their pricing structure being eroded by artificial, structures in between the value chain.
Let's go to this question from Rebecca Powell, who's asking via LinkedIn, what will happen to the global economy once social welfare checks from various governments stop rolling out? Maurice, how do you see this playing out?
These support payments have been supporting consumer demand in many economies in a situation where in many places people have lost significant amounts of income. In the United States, for example, a cliff is being approached where enhanced unemployment benefits will run out. And unless Congress acts and acts swiftly, this will have a very negative effect on growth in the U.S. and by implication on other countries. People will be unable to pay rent. There could be cascades of payments problems throughout the economy. There's also the issue of support for state and local governments in the U.S. Unless that comes through in a big way, there'll be a further source of austerity, of fiscal contraction, which could be devastating for the U.S. economy. And in many economies throughout the world, there's similar dynamics in play.
And Erica, how confident are you that businesses will learn from this latest crisis and actually change their behavior so that they don't operate so close to the financial edge in the future?
I think that I would have to say I'm not extremely confident. As somebody who's lived through the dot-com bust, long-term capital, the mortgage crisis, we tend to not learn our lessons for extremely long. One of the unfortunate consequences of capitalism is, there is a cost of capital. And so for a company to, maintain a highly insulated balance sheet is expensive. And sometimes shareholders, are not willing to pay that price. I hope that we will learn some lessons around, how to treat employees in a crisis, how to maintain a brand. I mean, for the U.S., we've not only gone through COVID, but we've also had significant challenges from civil unrest and civil rights issues that companies have had to learn from. So all of our businesses have been learning a lot in a very condensed period of time. I can only hope that they take away the lessons and help build a stronger and more secure future.
Maurice, a follow-up for you. Would letting businesses fail rather than bailing them out with taxpayer money improve economic stability in the long term?
Economists talk a lot about moral hazard. If you bail people out, if they expect to be bailed out, then they will behave badly because they expect a bailout. And that's one of the challenges for financial regulation, to balance that moral hazard against the fact that, when the economy is imploding, you really need to support the economy because there are too many innocent bystanders. In a situation like the one we are in now, you just can't be discriminating, unfortunately. And there are businesses that are probably being bailed out now, a few of them, which shouldn't be bailed out. The greater good, however, clearly pushes us to the kind of very strong support operations that we've seen from monetary policy, from fiscal policy, without which I think we would be in much worse shape than we are now.
Dolly, do business executives see this latest crisis as a one-off, or is there recognition that there are structural problems that need to be addressed?
We cannot ever afford anymore to have a situation where we do not prepare our economies and our own countries for any eventuality. You cannot be over-prepared because you never know, but at least you should be able to make sure that when that kind of thing comes, you are not left to wanting. You do not collapse. At least even if you do receive aid, it's on the basis of strength as opposed to such a weakness that you fail to survive without that aid. The too big to fail, the kind of concept doesn't work, because when that failure comes, it has a massive consequences on everybody, on employees in the business, stakeholders, and on the economy as a whole, resulting in exactly what Maurice is saying, a balancing act, whether or not you let that company collapse or you let it fail. So executives are better advised to ensure that they can at least withstand these hard trade winds that are caused by the pandemic. And I think we all advise also, and lastly, to heed what Bill Gates has said, to have the ability to foresee that these things can happen, and we absolutely have no control over them.
We'll have to leave it there. Thanks to all of our panelists for sharing their perspective. Maurice Obstfeld, former chief economist at the International Monetary Fund. Dolly Mokgatle is the co-founder of Peotona Capital, and Erica Duignan, co-founder of Rain VC. And as we've been hearing, the success of this global recovery will depend on our ability to balance so many different competing interests. That's certainly the case for the world's central bankers, who hold a lot of sway over the fate of the global recovery. So let's turn to someone who led those efforts during the last financial downturn. Joining us from Paris is Jean-Claude Trichet, former president of the European Central Bank. Jean-Claude, thank you so much for your time. Lots of questions coming in from people around the world for you to answer. Let's get straight to it with this first one. Now, as someone who's experienced this type of situation firsthand, how effective would you say financial leaders have been in responding to the coronavirus pandemic so far?
I would say that we have to cope with the worst crisis ever, as far as the real economy is concerned, as far as the financial economy is concerned. And I would say in these circumstances, what you have to do when you are either a government or a central bank is to cope with the crisis with a view to avoid absolute catastrophe, namely a dramatic depression. And I have to say that from that standpoint, the extremely bold decisions taken by the governments and the central banks were effective. Cooperation is of the essence. It is, by the way, what happened in 2008, 2009, when we had the G20 mobilizing itself, and the cooperation was really something which was very visible. And I have to say, also efficient and effective. In the present circumstances, we are in a totally different universe. I would say national populism had expanded in many, many countries the world over. And as we could all see, it was quasi impossible to have the appropriate level of global cooperation that was needed. So we are paying a price. We will see whether it's a very high price or not, but we are paying a price for this absence of global governance.
So how much responsibility do central bankers bear when it comes to global financial fragility, and what can they do to better support the world economy?
I deplored several times publicly myself that the central bankers of the advanced economy were very much the only game in town over the last 10 years. It's absolutely clear that since the great financial crisis, all central banks of the advanced economy have been more or less abandoned, if I may, by governments, by parliaments, as regards the fiscal side of the coin, also by absence of correct structural reforms, absence of correct participation of all other partners. And that made, of course, the central bankers having much more, I would say, abnormal weight on their shoulders in comparison with what they normally should have done. And there, of course, you can explain why we have seen accommodating policies. I trust they were necessary. I trust that these accommodating policies were in line with the threats that the central bankers had to cope with, but I deplore that they were alone. And in the future, they should not be alone.
And here's another question. At what point do you see monetary policy tools like stimulus and negative interest rates no longer working to boost the economy?
I would present the question a little bit differently. I would say, when do you think that the work which is to be done by other partners, and some changes in the functioning of the real economy of the advanced countries will permit the central banks to go back to a more normal attitude, a more normal monetary policy. And it seems to me that it depends very much on several factors. As I said, governments, parliaments doing their job. It also depends on new elements that would, I hope very much, change the picture. For instance, productivity going steadily higher in the advanced economy, because what we have to cope with is a low level of productivity since more or less 2005, 2006. So that's a problem. A second problem, which is a very important problem in my eyes, is that the bargaining power of labor has been considerably diminished in many advanced economies, even when there is full employment. This is very abnormal. When you are at full employment, normally you must have pushes up in wages and salaries. And of course, all depends then on productivity and the way productivity is operating. But it's abnormal that you don't have at least augmentation of wages and salaries in nominal terms. And if you have that, then, of course, you have not the problem of very low inflation that we have today. So you see the combination of more bargaining power given to labor in countries that are at full employment and a higher level of productivity, higher level of structural reform that would augment the capacity to grow. This should normally permit to have a more normal functioning of our economies and central banks to be out of the very, very difficult situation in which they are today, which is not their fault, in my opinion, but of course creates abnormal overall environment.
Okay, looking ahead, what about for the next time? What steps can governments and businesses take to become more financially resilient and prepared for the next crisis?
Clearly, the best recipe remains sound policies, sound fiscal policies, sound structural policies, avoid over-indebtedness as has been the case in the past, and be sufficiently courageous to try to solve the problem when they appear. The idea of mudding through, the idea of rolling the can along the road is a very bad one. It is more or less what we have done in the last 10 years. It is more or less that we did before the last 10 years. So that makes a lot of 20 years, say, of abnormal behavior. So my main message would be sound policies remain of the essence. And there is no free lunch. There is no way of avoiding to be reasonable and responsible.
Well, that's all the time we have. Thank you so much for joining us. We've been speaking with Jean-Claude Trichet, former president of the European Central Bank from Paris. This is a topic we'll all be tracking closely for a long time, and we're continuing the conversation online. Let us know your thoughts on what our experts had to say, and if there's a question or issue you'd like us to discuss. You can find us on LinkedIn, on Facebook, and on Twitter at Globalive Media. Make sure to join us next time on Globally Speaking. Our world, your voice, global perspectives.